provide forgivable loans to small businesses and nonprofits to help those businesses and nonprofits retain and rehire employees. And as I said, I think most of you have taken advantage of that program. It was a really successful program. It was a bit of a moving target, as you will find this is, because everything was moving so fast in the spring. But I think at the end of the day, it ended up being a program that, despite its bumps, was helpful to a lot of organizations. That round of financing ended in August of 2020. So back in August was the last time that you could apply for that. And borrowers are no longer able to access the PPP1 program. And I'm only saying that because in the last couple of days, there's been some confusion. And I think it's just some awkward drafting in the material that's being presented by the Treasury and SBA. I mean, I understand where it's coming from. It's just some inartful drafting that makes it sound like some borrowers who have not taken advantage of PPP1 could take advantage of PPP1 and what we're going to talk about today, which is PPP2. That is not the case. So to the extent that you've read anything or inferred anything that you can access PPP1 at this point, you cannot. So that brings us to PPP2. As you know, on December 27th, the president signed what is called the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. And that act, among other things, provided $284 billion for a second round of financing under PPP. And it's intended to help small businesses and nonprofits who have experienced a significant revenue loss due to COVID. One of the differences you're going to find from going through PPP1 and PPP2 is that 2 is focusing in terms of calculating whether or not you're eligible to participate. That calculation is going to be based on revenue loss, and we're going to talk about that some more, instead of employee payroll costs, which is what we talked about earlier. Just someone sending me a text about the not being able to get into the program. So anyways, it's going to be calculated based on revenue loss, and we're going to talk about that. But the focus on the program continues to be the retention and rehiring of employees. And so there's going to be a continued focus on that 60% loan amount. If you want to qualify for 100% forgiveness of this PPP2 loan, 60% of loan proceeds are going to have to be used for our famous payroll costs. And we went through this all in the spring, but by way of review, we're going to go through it again today. So continuing in a general manner, what are we allowed to do under PPP2? So first of all, it gives PPP1 borrowers a chance to do a second borrowing under the program. So even if you were a PPP1 borrower, you can still take advantage of this program. It provides new borrowers a chance to access PPP. So if you didn't get a PPP1 loan, you're still able to get a PPP2 loan. We added a number of different types of borrowers, and we're going to talk about that in more detail later, but we've added a number of different types of borrowers that were not able to access PPP1, but are now able to access PPP2. And you're going to find that under PPP2, you're going to be able to use loan proceeds for more things, more types of expenses than you were allowed to use them under PPP1. Okay. And this is where, and I alluded to this a bit, if you recall from the spring, there were some bumps in the roads in terms of, we had the initial CARES Act, and then we had some regulations. and then we had amendments to the regulations, and then we had more amendments to the regulations. And each increment, each step of the way, the regulations became a little more borrower friendly. The program became easier to access, the forms got easier, and the terms by which you could borrow money, repay money, seek forgiveness became more beneficial to the borrowers over time. That's sort of kind of where we are right now. There is a initial statute out there that was, again, signed by the president on December 27th. And under that statute, it says that regulations have to be distributed by SBA by end of business on January 6th, which was yesterday. And as of 11 o'clock, I looked and I have found no new regulations. So again, this is one of those times where we're just going to have to figure it out together. I've got the general rules here, but you're going to find as we go through my presentation, I'm going to be, there's times where I'm going to say, I just don't know exactly how this is going to work. We're going to have to wait for the regulations. But know that they've been promised and presumably they will come quickly. As soon as we have more information on how these things are going to work precisely, we will certainly post them on the firm's website. But one of the things and one of the lessons SBA took from this spring is they've really tried to simplify and streamline the applications, especially for small borrowers. And in fact, in the legislation itself, it requires that SBA, for loans of less than $150,000, that SBA make those loans and make those forgivenesses on one-page documents. And again, we don't have those one-page documents, but presumably for much smaller loans, for $150,000 and less, we are going to have very, very simplified forms to use. And by extension, I'm presuming that larger loans, and a lot of you folks represent larger organizations that are going to have loans in excess of $150,000. Presumably those will be more streamlined than they have been in the past. Again, one of the things that they're providing for smaller lenders is, as part of your certification process, you as an organization are going to have to certify that that your organization is facing current economic uncertainty. But the presumption is going to be that if your loan is less than $2 million, that by making that certification, it was in good faith and you won't be audited on it. So, certainly, I'm not advising that you do, anything untrustworthy, but, just so you know going forward that the certifications you're going to be made are not going to be scrutinized maybe as much as they would have been in the spring. Okay, PPP 2 loans, like PPP 1s, are going to be submitted through traditional lenders. In the spring, we had a lot of borrowers who were taking advantage of both the PPP program and the EIDL program. And if you recall, the PPP loans went through traditional lenders, your local banks and credit unions, whereby the EIDL loans were submitted directly to SBA. Because this is just built on top of what we did in the spring, these are going to be submitted to traditional lenders. So my best advice to you, and this is advice that I gave 10 months ago, but based on feedback that I've gotten from lenders, in the last year, the more organized you are, the better. Make it easy for the lender to say yes or to jump you to the front of the line. Patting ourselves on the back a little bit, we had put together some canned officer certificates and some resolutions, and the feedback we got from lenders is they just love those because many of their borrowers came in with, a folder stuffed full of loose leaf paper, and, we're trying to give them things, provide them information sitting there at the desk. Get yourself organized. Take advantage of the officer's certificates that we've prepared for you, and those will be on our website. We'll talk about them in a bit. And, go in, because if you're able to hand your lender a neat, organized loan package, it's going to jump you to the front of the line. All right. So
Jeff,
dealing.
can I
Sure.
pause you? I fixed the problem. And so I am admitting people now. And all I can say is, I'm sorry. I learned a lesson. I guess you buy the large room or large meeting option, and then you have to actually assign it to the license holder. So that didn't automatically happen. So the fact that we got 160 registrants made me think all those people were going to get in. So anyway, I am madly admitting more people. Jeff, we'll just have you keep going. We are recording this. We may have to loop back ourselves and repeat some of the beginning. But for those of you that are just joining, sorry about that. And we will, as I said, follow up with both what you missed and the recording. Okay, we'll just pretend none of that happened and carry on. Go, Jeff. Thank you.
Okay, well, welcome to our new participants. I will tell you, you haven't missed a ton. I was just kind of doing a brief review of how we got to PPP2 through the process of PPP1 in the spring. And then right now I'm giving kind of a general broad 10,000 foot overview of PPP2. And in a minute, I'm going to start diving into more specifics. So as much as I would love to think that everything I've said in the last 5 minutes has been brilliant, it has been largely an overview to set up the more specific parts of this presentation. So that's where you are. So where I was before our new folks joined us was talking about, again, putting together packages for your lenders that make it easy for your lenders to say yes. Now, lenders, and we talked a bit about this in the spring, is, the lenders aren't worried about these loans being paid back because they're 100% guaranteed by SBA, but they are also regulated. The banks are also regulated under the Bank Secrecy Act, and they have obligations under Know Your Customer requirements. And that requires them to, make sure that their borrowers are borrowing money with the authority granted to them by your various board of directors and your governing documents. And so putting those officer's certificate is really helpful because, number one, it makes you look like you know what you're doing. And two, it gives your lender more confidence that everything that the loans that you are applying for has all been properly approved by your organization. The other thing you should do is, to the extent that you have other loans out there, and you probably did this in the spring, but it's worth mentioning again, if you have other loans out there, check your loan covenants and any debt service coverage ratios you have to make sure that the debt you are about to take on under PPP2 doesn't violate a covenant somewhere else. Again, put together organized officer certificates that include the certificate itself, your articles of organization or articles of incorporation, your bylaws or operating agreement, a certificate of status saying that you're still a organized corporation or LLC in the state of Wisconsin or wherever you're from, and then a set of resolutions demonstrating that everything has been properly authorized. And we're going to have a set of those, very similar to what we did in the spring, on our website. So you guys will be able to access that and feel free to steal shamelessly. Again, complete the applications and calculations neatly and in advance. Again, from everything they're telling us, it should be easier this time than it was under PPP 1. Also organize your backup material. And this time it's going to be more important that you know what your gross revenues, or if you're a nonprofit, what your gross receipts are. So make sure that your income statements are in order, because you're going to need information from that. Know what your payroll costs are, because you're going to need the payroll costs to calculate loan amounts. And again, officer certificate. Applications have to be in by March 31st. But if you recall, the first round of PPP 1 back in the spring was exhausted fairly quickly. So applying earlier is better. Okay, so who can apply for a PPP loan? So small businesses and nonprofits, sole proprietorships, everyone who took advantage of PPP 1, you're certainly continue to be eligible. In addition to that, in the nonprofit world, we have also authorized 501c6 organizations and destination marketing organizations. They are allowed to apply for a PPP2 loan. This group was not allowed to apply earlier, but they have been added in this round. So if you're a 501,
Jeff, can I jump in on the C6s?
yeah,
So there's some details about that people are asking us. You
Okay.
see here on the receipts. We'll, oh, you can go back. For those of you that are 501c6s, just stay tuned. If you have any confusion on what receipts from lobbying means, it's the portion of your dues that you segment off for lobbying, which obviously should be no less than what you spent on lobbying. And we will give you a little more clarification of that in Q&A that we follow up on. I also, just why I grabbed the floor from you, Jeff, I want to just remind everyone that regardless of what type of entity, you had to be in existence as of February 15th, 2020. So if you were incorporated and got going since February 15th, 2020, then you are not eligible for a PPP loan. Correct, Jeff?
correct.
So sorry for the bad news, but.
Okay, so going back to, so whether you're a new borrower or an old borrower, you have to have been in operation by February 15th, 2020, as Melissa just indicated, and you have to have fewer than 300 employees. If you had a PPP 1 loan, you must have used all of that money or will use all of that money before you apply for a PPP 2 loan. So if for some reason you haven't exhausted all of your PPP 1 funds, you're still in your covered period, you have to use all of that money up before you're allowed to pay for a PPP 2 up. The one exception for that is some weirdness that we're going to get to in a little bit, that allows you under certain circumstances to pay back unused parts of your PPP 1 in order to maximize PPP 2. We'll talk about that. I can't imagine there's a lot of you out there that would fall into, but they put it in the legislation, so I'm going to bring it up. So in order to show your eligibility, you must show that your organization has had a reduction in gross revenue or in gross receipts if you're a nonprofit for at least one calendar quarter when compared to the same calendar quarter in 2019. So this is where you go back to your income statements, and if you can say that, oh yeah, second quarter of 2019 compared to the second quarter of 2020, we can show a 25% reduction, or the third quarter. So It has to be right now, subject to the regulations coming out. The statute itself says that it has to be comparing calendar quarters to calendar quarters. So I'm, first quarter, second quarter, third quarter, fourth quarter, go back and compare those to what you did in 2019. And if you can demonstrate a 25% reduction, then you are eligible.
Jeff, there's a question about this, and it's a good one. Given that we said you had to be in existence by February 15th, 2020, by definition, you don't have a 2019 quarter to compare to. They're going to have to figure that out. But Jeff, do you have any insight yet on how we prove reduction in revenue when there was no 2019?
No.
Okay.
I have no insights on that.
Okay, so that's another one of those Q&As, and we will be updating on that. And for those of you that I know this applies to, we'll also be in touch.
Okay, so how much can you borrow? So in terms of your loan size, you are allowed to borrow the lesser of $2 million, or 2.5 times your average payroll costs in the 1 year prior to loan application or calendar year 2020. So instead of going through the goofy calculations that we went through this spring, basically the easiest way to do this is, if you were in operation for all of 2020, just do an average monthly payroll cost and multiply it by 2.5. If you do it a little bit later, because it's more advantageous to include January or February, you can certainly do it in a 1 year period. If you are a seasonal employer, you're allowed to calculate the maximum loan amount based on any 12-week period between February of 2019 or February of 2020. You're going to find in PPP2 there's more flexibility in terms of allowing you to pick your own dates on when you're measuring things. If you happen to be in accommodation or food service, those organizations that were most hard hit by COVID, you're allowed to boost your loan size by calculating it at 3.5 instead of 2.5. If you are a new entity, I didn't have your question for your last new entity question, Melissa, but I do have one here. If you're a new entity that doesn't have numbers going back to 2019, just calculate kind of a good faith monthly payroll cost. Okay, our magic payroll costs. These are the costs that, and again, none of this, well, except what we add at the bottom, none of this should be new. These are basically the payroll costs that we had for PPP1. Compensation, tips, payment for vacation and family leave, separation payments, employee benefits, state and local taxes assessed on compensation, and then certain self-employment calculations. And I think this is awesome, because in the spring, the most asked question I had in all the questions that I fielded, and there were hundreds of them, the one that kept coming up over and over and over again is, are we allowed to use our contributions to health, life, disability insurance premiums? And the answer was no, but now the answer is yes. So you are allowed to put those costs in to boost your payroll costs. All right, so once you get a loan, how are you allowed to use it? Again, this is another area where there is more flexibility than there has been in the past. But despite the new flexibility, continue to be focused on that 60-40 split. If you recall, when we first started talking about this, it was the 75-25 split, where 75 had to be used for payroll costs and 25 for all the other things, all the other eligible costs. And then later, after we went through a number of iterations of this, they finally settled on 60-40, but that 60-40 split remains if you want full forgiveness. So as you're going through and spending your loan proceeds on its various permitted uses, always kind of keep an eye on that 60-40 split to make sure that 60% of it is being used for payroll costs, at least if you want 100% forgiveness. So most of the costs under payroll costs are everything that we're familiar with from PPP1. Payroll costs, again, at 60%, mortgage interest expenses, rent expenses, utility expenses. But then we've also added some new eligible expenses, which include payment for software, cloud computing, and other human resources and accounting needs, uninsured costs related to property damage caused by civil unrest. So if for some reason during the protest this summer, your organization suffered some sort of property damage loss, and that loss was not covered by insurance, it was within your deductible or didn't otherwise fit into a neat little insurance box, you're allowed to use those to reimburse yourself for those costs. Supply chain costs for your organization's essential needs pursuant to a written agreement executed before December 27th, 2020. So if your organization has certain items in its supply chain and there's an agreement out there that was executed before December 27th, a purchase contract, a purchase order of some sort, those supply chain costs, you're going to be able to use loan proceeds for them. If you're buying perishable goods, you're in some sort of food service industry or somewhere else where you would have perishable goods, those are, those supply chain items you're going to be able to include under this category, regardless of when you buy them. In addition to that, yep.
Sorry. Were you about to go on to a new
I'm
topic?
just going to say that, and the final thing that is now permitted are PPP expenses.
Okay.
Or Jesus, PPE expenses.
Right.
The PPP loan.
Right. Question, someone Eagle Eye said that on our slide about insurance, expanding the definition of insurance, that health insurance was not included on that. Was that an oversight or was it already eligible?
Group health was already eligible. It was the
That's
other
what I
type
was
were not eligible.
Yeah.
So if you go up to the, I think you're looking at my screen. Yes. So
Benefits like group health coverage got it.
Yep.
That's
So
right.
those were, and then we added these other types of.
Perfect. Yep.
Sorry about that, if I was confused.
No, I think, yeah. Okay.
All right. Okay. So now we're moving on to forgiveness, because at the back end of this, we don't want to pay any of this back. And again, eligibility for loan forgiveness is getting easier. But we still have that 60% requirement, payroll costs. You now get to choose your own covered period. I think in the spring we had pages and pages of calculations on what was a covered period. Now you can pick any covered period on your own, as long as that period exists between 8 and 24 weeks. So once you have spent your funds, or as you're planning to spend your funds, kind of eyeball your calendar and figure out what period of time, what covered period is going to be the easiest for you to use up these funds, because you don't want to pay them back. All that being said, the SBA, and this was the legislation itself, this wasn't even the rule, the legislation specifically calls out that that if you reduce your the number of employees or your employee salaries by more than 25%, that is going to impact the amount that you get forgiveness for. So again, PPP, it's in the name. The goal of the program is to make sure that you are retaining and rehiring employees. To the extent that you are unable to do that and your your pre-COVID employee status drops by 25%, that's going to impact your loan forgiveness. It's not prohibited, it's just going to impact how much you get forgiven. So kind of eyeball that along the way as well. And I mentioned this earlier, but again, in the legislation, it says that for small loans less than $150,000, there is supposed to be a simplified one-page procedure for forgiveness. As soon as we have that, we will share that with you as well. But again, in the legislation, it talks about that if you're going to receive certification, you know, they're going to ask very few questions, you know, but they are going to ask about descriptions of the number of employees you were able to retain, the amount spent on payroll costs, and all of that, how that compares to your loan amount. Okay, so what are some of the other changes under PPP2?
Jeff, sorry, quick, good questions under chat here. So have to use up the funds, you choose the period and you use them up within 24 weeks?
You have a maximum of 24 weeks.
Right.
So if you think you can use them in 8 weeks, you can pick a covered period for 8 weeks. If you think it's going to be 14 weeks, use 14 weeks.
And the reduction against the 25% reduction is in comparison to what? February 2020?
So that's, again, we're going to have to see what the regulations say. If you recall from PPP1, there was, let me back up. There are a couple of ways your loan forgiveness can be impacted by a couple of different things. If your organization is trying to achieve 100% loan forgiveness, then on the expense side, you have to stick to that 60-40 split, where 60% is payroll costs and 40% is the other stuff. If you fall below that, let's just say that, you know, in order to keep your lights on, you have to spend more on rent than on payroll costs, and that split falls to 50-50, that is going to impact how much your organization, how much forgiveness you get. And if you're not at 60-40, the amount forgiven is going to be reduced, which means you're going to have to pay back some of that loan.
Right.
On a completely different calculation, because the goal of the program is to retain and rehire employees, to the extent that you have PPP funds, yet despite all your efforts and despite this extra funding, you drop below 75%, that's going to impact your loan forgiveness. It's not that you can't do it, it's just going to impact how much you are forgiven. So those are two separate calculations. So in the spring, that second calculation, the 25% calculation, was based on, and you're stretching my memory a little bit here, but I think it was a measurement from the the middle of January until the end of March. And that was our period where we measured how many employees your organization has. And that was all based on an FTE calculation, but that was kind of the base number. And then based on that base number, that was kind of a pre-COVID calculation, then we measured that 25% reduction from that. Right now, for PPP2, I'm assuming we will do something similar, but the statute that came out of Congress doesn't have that type of detail. So I can't tell you that it's for sure, but I do know that Congress thought this 25% reduction number was important enough that it put it in the legislation to put us all on alert that they are going to be looking at that, and there's going to be regulations that are wrapped around that. That felt like a long answer to that question, but I think it's an accurate answer to that question.
Jeff, can I just do a time check here? So we
Sure.
want to leave 30 minutes for Sarah.
Yep.
About how much do you think you have left?
Give me 5 minutes.
Okay. And we have a question from someone who, just confirm that I'm right, that, they don't qualify for PPP if they have no employees. However, they could qualify for EIDL.
Correct.
And so EIDL is something that we covered in our last spring. There are resources up on our website related to that. But Jeff, if you have a quick minute to just explain what the EIDL is, that would be good too.
Okay. Do you want me to do that now?
Sure.
Okay. So in EIDL, in the EIDL program, unlike PPP, was a long established program that SBA uses for small businesses in disaster areas. The example I always use is a tornado goes through a small town in Iowa. And when that happens, FEMA comes in and they work on all the health and safety issues and put roofs over people's heads and et cetera. Well, with FEMA, SBA rolls in and they have these things called EIDL loans, emergency disaster relief loans. And so if you are a small town bakery, you get these very beneficial loans to help you get back up onto your feet. And those loans include a $10,000 upfront grant that no one ever looks at and no one ever asks about. It's literally, here's $10,000, get yourself started in putting your business back together. And then the rest of the EIDL loan is a low interest loan that SBA does to help businesses that have been struck by disaster. Okay, it's a long established and very smooth running program. In order to boost money into the economy in the spring, Congress and SBA said, okay, normally the president has to declare a disaster area, the small town in Iowa that just got hit with a tornado. Someone has to say it's a disaster area for all of these programs to kick in. What happened because of COVID is the president and the Congress and SBA said that the whole country was a disaster area, and therefore any business was eligible to apply for these EIDL funds, which included a $10,000 upfront grant. And so many of the people on this call took advantage of both programs, both the PPP and the EIDL loan. So the EIDL is, it's a little more flexible. You don't have to just do it on employees. And we can certainly provide more information going forward.
So Jeff, I'm also just saying, people are asking, We don't know for sure how that $10,000 issue will be resolved for those of you that have already sought forgiveness.
That's what I need my 5 minutes for.
Okay, go ahead.
Okay, so if you've been looking at the slide as I've been babbling, the one of the things that PPP changed was that EIDL loan advances are no longer subtracted from PPP forgiveness. So those organizations that took advantage of both programs, when they did their PPP loan forgiveness, they were not allowed to, let me rephrase that. When organizations that had both loans did their PPP forgiveness applications, they had to offset a forgiveness amount by that $10,000 grant that comes with EIDL. It's a source of much contradiction, but that was the way it worked. So going forward, that is no longer the case. You don't need to offset that. Okay, so to the extent that you have not, so to the extent that you have, your organization has both loans and you haven't applied for forgiveness yet, you, and even just if it's a PPP1, you no longer have to offset that $10,000 grant. In addition to that, what PPP2 says that if there's any rules under PPP2 that are more advantageous to you, that allows you to come to a better loan forgiveness number than you would under the PPP1 rules, you are now allowed to use PPP2 rules to do that. Now the question becomes, if you've already applied for forgiveness, are you allowed to go back and amend your forgiveness application and take advantage of the EIDL grant and the other rules under PPP2 that would have given you a better result under PPP1? And the answer is, I don't know. There are certainly some illusions out there that maybe you are able to. There's some stuff in the statute that talks about PPP1 borrowers being able to take advantage of this, even if things have been submitted to SBA. I have no idea how this is going to work out, but as I say on my screen, I predict it is going to be a mess. So stay tuned.
And that is a great segue. Are you done?
Yeah. Yeah. So the other stuff is just take a look at the other slides. It'll be on the website. I talk about some additional appropriation, and I guess the one thing I would say before I leave, Melissa, is that, everyone take a look at the slides. One thing that is more of a focus in this program than in the past is a certain amount of outreach to underserved communities, and a bunch of money, billions and billions of dollars, is being set aside for underserved communities. Unfortunately, a lot of communities were not able to take advantage of the program in the spring, and we hope to avoid that going forward. So, you folks are out there in the nonprofit world. If you're aware of organizations that need our help, have them reach out to us, because we're working on those programs as well. That's it. I'm done.
Great. Thanks, Jeff. And I will go back to sorry. don't want to share screen. There we go. We're back. Okay. So good segue from Jeff there on the underserved communities issue. The law says that they have to give more guidance on that issue. They haven't. They had 10 days from, we assume, signing. That may be tomorrow. And we're tracking it. So just know, for some of you that it's very applicable to, we will be probably in touch directly. We also will be putting that on our Q&A, which we keep referring to. And for those of you that participated in the spring, I think you caught on to a pattern of our schedule here. We move as quickly as we can, but we also want to get our stuff right. And so these slides often don't go up the same afternoon. We will be working on getting a Q&A together based on questions in the chat and questions we got ahead of time. And we will also then send around those and the slides with an email to all that were registered for this webinar, and we will post on our website. But please be patient. It could take a couple days. And you can also trust that if the SBA comes out with something definitive, or if we know that the portals are opening, we learn anything from the financial institutions, we will send an update and put something up on our website. So do check the website periodically if you wonder what's going on. And Tom Linfield points out that Madison Community Foundation will also be posting this information. So on that, I'm going to turn over to Sarah. So why don't you get teed up, Sarah? I'm going to share the screen with you now.
Sounds good.
And I guess I'm just going to say two quick things too. We also refer to the fact that there are these shuttered venue grants that are in the alternative to a PPP. You cannot apply for both. We did not address and will not address the shuttered venue grants here, but we did put that question in our registration, and we know who you are to the extent you're interested in that issue, and we'll be following up. And in all of these cases, we may decide that doing some small group Zooms makes sense when we get more specialized information. So stay tuned on that front. Yes.
Yeah. Hey, I just so you know, I put some very general information on shuttered venue at the end of my presentation, kind of an FYI to get people thinking about it. Certainly nothing definitive, but people can look at that. Great,
great. I think it's more, well, I know it is more favorable to a shuttered venue than a PPP. So, okay. I am also aware that there's, the eviction moratorium for some of you that's relevant. It's through the end of the month. We all have heard that that's just not as valuable as one would like it to be. There is some eviction rental assistance. I'm actually trying to get my arms around that to know if we can give any advice on how you could help some of your clients perhaps access that. I also understand there's some more childcare grants that came through this new act that was passed at the end of the year. So, okay, Sarah, for real, now it's your turn.
No problem whatsoever. Let's see. Are you all looking at my entire screen or just at my PowerPoint?
Entire screen. Oh no. Well,
kind of a disaster.
Right. No, not entire screen. Sorry.
Oh, good. You don't want to see it. It's a little cluttered. All right, good. If you're just looking at that, that's great. And if you've stuck around, thanks. I hope I make it worth your while. The way that I prepared today is I looked back at, and I actually repurposed the slides that I had, if you were with us last spring, on introducing different relief that was available to employers through the CARES Act. I took that and really just modified the slides so that you could see exactly what has changed and what it's changed to. So hopefully that's useful. Jeff already pointed out, and I'll reiterate that that we're just going to keep you informed as we find out more information. Right now, there's nothing updated from Wisconsin, and there are some things where items have been assigned to them for action, and we're just. There are a few areas that I'd love to have more information for you, but it's just not available at this time. We'll wait until we get more guidance from the Department of Labor. So diving right in, the first thing I wanted to point out is there have been some real changes to the employee retention tax credit. It was one of the first things that came out. I believe it might have come out at the same time. Now I'm forgetting, it was part of the CARES Act. It was largely dismissed by most people because before, if you were a PPP participant at all, if you got a loan or I believe even were in the applying for it, you could not have the employee retention tax credit. That's the big change there. And I'll get to the slide in a moment, but I do want to point out that it's actually a retroactive change. So it applies to 2020, which is surprising. Of course, same rule that always applies. You shouldn't double dip, so it can't be on the same amount of cash for which you're trying to get loan forgiveness through the PPP, but it no longer, I highly recommend everybody look into whether that's something that's available to them for 2020 if everything applies. And just a reminder on that, the application, it was eligible, you are eligible if you had those suspended operations because of government order, which applies to some folk, and that will also be extended and continue for the first 2 quarters of 2021. Now, not retroactive, just for 2021. Instead of it being a requirement that your gross receipts are below 50%, it's now 80% of the comparable quarter in 2019. Note that the comparable quarters, if you were not in business in 2019, then it is okay to substitute 2020 for comparing receipts. But for most organizations that have been around, it's going to be an easier mark to hit when comparing to 2019, which is what's intended. All right. A little more on this. So the wages and benefit, it applies to the wages and benefits. Now it's being extended through the end of Q2 of this year. And instead of it being something for which you can apply to 50% of wages and benefits, it's up to 70%, meaning that the maximum per employee total could be $7,000 per quarter. Pretty substantial, $14,000 for the year. And then I've changed this again on the bottom, as you see, that it cannot be used on anything, on any amount that you are receiving a FRCR credit for, or which we'll get to in a moment because there are a few little changes there as well, or by any PPP loan forgiveness application amounts. Okay. Let's see. And to close it all out, nothing's really changed in terms of what the implementation is. Again, it's something that can be applied against the employer's share of Social Security. If it's more than the amount that's due, there's a form that's available to apply for a refund on a quarterly basis. All right, as I mentioned, we're getting to the Family First Coronavirus Response Act. While it has been extended as an option for employers, it is no longer mandatory. That's the big change. And just remembering what this was about for folks who didn't come to use it, it applies to all employers with less than 500 employees. And it is a 100% reimbursement. So while it is no longer mandatory, that incentive that income is 100% reimbursed is still out there to encourage and encourage, I would say at this point, employers to offer it. But there's a lot here. We don't have time to get into it. If you are revisiting needs for Family First Coronavirus Response Act, I'm happy to share more materials or talk with you about it. But there's really 2 leaves under there. One is for 2 weeks. That's for the reasons listed on this slide. And then the other one, which is really just associated with school childcare closings when there's a bona fide need to provide care for a child. And that's what gives the additional 10 weeks of the Expanded Family Medical Leave Act. That portion is something that employers that have less than 50 employees could potentially declare back in 2020 that they were in a position where they couldn't offer that. That's obviously no longer, it's moot now because it's not mandatory. All right, and then the last slide, which I used before, it still applies that any credit that's used from this leave and the reimbursement that can come from the government is not eligible for the employee retention tax credit or PPP loan forgiveness, but the notice requirements obviously are not the same. However, on that note, I would say that if you do decide, which I'll get to my next slide, that's one of the action items, is if you decide to offer this to your employees through the end of March 31st, just having some sort of a notice on your own. Otherwise, you're following the what were mandated dates the same way in all other aspects as you just saw. The other things to key notes here is just don't discriminate, terminate, or retaliate any employees for using this leave. Address counsel if there's a conflict, there's a problem. And then inside of Wisconsin, well, for everyone, consider how it works with Federal Family Medical Leave Act as well as Wisconsin Family Medical Leave Act. If you're here, another note for if we've got anybody from out of state is there are a number of states that are instituting mandatory general leave this year. Just be aware of those as well. All right, so the next section we're going to switch into is just a brief review of where we are with unemployment insurance, including work share, and what changes have been made. So as a reminder, it is even more important, even though I would have said it was very important last year, to flag every unemployment insurance claim, both as an employer and advise your employees to as a COVID-19 related reduction in hours, whether it's partial or whole. That becomes even more important here, and in some cases mandatory. I'll show that on a future slide. And then timely and accurate, advise employees to get their applications in right away. And if you're an employer and you get something even that seems confusing, absolutely respond to it right away. It's kind of crazy because, as everybody is pretty much come to know, they're not very responsive or fast most of the time, but that doesn't mean that you don't have to be in order to save trouble for yourself and your employees later on if employees are utilizing unemployment insurance. Ooh, something I didn't list in here but came up as of November in Wisconsin. If you do reduce an employee's hours or terminate them from November through some indeterminate point, you do need to advise them, almost like you would COBRA language, if they were losing their healthcare benefits, that they could apply for unemployment insurance. There's language that I highly recommend using right on the Department of Workforce Development site. And it's good in that it's not making any promises that they will get that relief. It's just advising them that it's something they can look into. So definitely do that if you have any reduction in hours or terminations coming up. Let's see. So diving right in, there were 4 major camps of unemployment that came up from the CARES Act. And the one that got a lot of attention, of course, was PUA. This is the one where, there are some details on the slide, feel free to read. But this is the one that was available to people who normally don't get, aren't eligible for unemployment insurance benefits. So what they've done there is, this just expired for people right as the bill was being signed. So there shouldn't be a gap in terms of coverage. There may be a gap and a lag time in terms of checks, but there shouldn't be a gap. 50 weeks is now the maximum amount that someone can get, and that will end March 14th, unless the recipient hasn't used all 50 weeks, in which case it will go on no later than, as of now, it will no later than April 5th of this year. let's see, and other things that are new are everything under that last bullet item that's highlighted, new documentation requirements. So some new things here is just some documentation requirements that are they're really beefing up on those, including, as you'll see, the third bullet point there, for PUA recipients, they're going to have to recertify the COVID related reasons for their PUA eligibility weekly basis when they submit their claim. All right, and then we'll know more later in terms of what the states are going to require, what Wisconsin, if you're here, is going to require in terms of identification of PUA applicants. All right. The second one was PEUC, or this is not as exciting as this one or the next one, but this was just extending from our traditional 26 weeks of unemployment insurance, providing an additional 13, and now that's being extended again to a total of 24 weeks, getting us to April 5th again, so reusing that date. Not too much else to say about that. In terms of what we know is work share here in Wisconsin is federally titled short-term compensation. I have to admit, I can't find my original slide on this, so I was kind of scripting one and seeing if I could remember what I'd had on there. But as far as I understand, the program hasn't changed in any way other than they are extending it through March, the week that ends March 13th, and we're a state where our benefit weeks end on Saturdays. So that's the Saturday that it'll end on. The Department of Workforce Development has not caught up. Their website still says that things expired on December 31st. We'll wait, we'll see. I can't imagine that there will be anything other than just a clear extension, because otherwise all of the rules applied that applied before in terms of opening up that pool of people that are eligible for this quite a bit from the standard legislation. All right, and then last, the way more exciting chunk of unemployment insurance was, if you recall, that $600 that was available until the end of July of 2020. That's being reinstated starting immediately. So for the last week actually, that ended on January 2nd, for 11 weeks total, ending on March 11th. And it is half, it's $300 a week. It will apply the same way. If you're receiving any unemployment insurance, you're going to, of any variety, traditional or any of the things that we just reviewed, including the work share, you'll automatically get the $300. It's not something that you apply for. One note though, there's no making up your 11 weeks. If you're receiving benefits for one of the 11 weeks that's covered, you'll get that $300 included in whatever amount you were assigned. However, if you only take advantage of 5 or 6 weeks, because those are the only weeks that you're eligible, you're done. The program will absolutely be done, no gaps, no phasing out. Okay. And then there is one new category that they've added. I imagine trying to hit a group of people that have not been left out entirely, but they haven't been taken as well care of as other groups. And these are mixed earners. And these are people who think they're traditional employees who probably be eligible for traditional unemployment insurance, but they also would be eligible for the pandemic, the PUA, for people who are not traditionally covered by unemployment insurance. And so those folks, if there's a sizable chunk of their income that accounts for that non-traditional and traditionally covered, or PUA right now covered work, self-employed work in particular, this is just allowing a little extra bonus of $100 a week. However, they do have to prove that they received over $5,000 in the most recent tax year of income through self-employment. And they already have to be receiving unemployment insurance benefits through something other than PUA, because obviously if they weren't receiving anything, they could just be targeting PUA, but they can't target it so long as they up until now, if they've already been in the system under traditional. So it's meant to somewhat put them in a more whole situation in alignment with other people who are just strictly PUA or strictly traditional unemployment insurance recipients. All right, any questions there? Doing okay? Okay, I have a few like mixed bag items, 3 more to be precise. So I'll get through those and then spare some time in case you have any questions generally or for Jeff or I. One is, if you can remember back to August of last year when the president had released a memorandum instructing the Treasury Department to defer the employees' payment toward their Social Security and their tax withholdings without any penalties or interest for wages through the end of the year starting September 1st. Well, there's a lot to say there. I'm not going to get into it now, but this act, this new relief bill, extends that period, so continues it through the end of this year. I believe, just from what I've read and from talking to a number of you, very few non-federal government employers have done this because there were a lot of reasons not to and not a lot of reasons to do it. It all seemed very uncertain. However, if you are in the camp of someone who has done it, who has opted to do it, there is no reckoning at this point, although it's unclear. We can talk about this later, but there may be a really big reckoning at the end. That much is unknown at this time. All right, another one of my mixed bag things, maybe not, oh, well, is employee benefits, which I just wanted to touch on in that Jeff had already noted my last bullet point here, but just to kind of tie it into the whole employment landscape, if you are seeking PPP loan forgiveness, they've expanded what you can count now as payroll costs with group life, disability, vision, and dental insurance. There are some other things that if they, strike you, I recommend looking into further or contacting us on disaster mitigation, which relaxes retirement withdrawals. There's allowances for flex spending accounts to be carried over, the amounts to be carried over from 2020 to 2021, and also employer payment of student loans is continued as it was in 2020. And then one last point, it's come up a lot. I don't have too much to say and I don't want to steal a lot of time away from something where we are really trying to focus on this new consolidated act. Excuse me. However, as vaccines are distributed, a lot of folks have been wondering how to incorporate vaccination levels of employees as well as members and visitors of their organizations into legitimate policies that meet compliance. I will just point out first that the EEOC has sidestepped things for now in that it has neither authorized nor prohibited mandatory vaccination policies by employers. Interestingly, it has come down on determining that COVID-19 meets a direct threat definition, so that maybe a little more ammunition for employers who do want to create mandatory vaccine policies. However, and there may be some reasonableness about it. However, I'll note my bullet points in that you're going to want to make sure with any mandatory policy that you include certain exemptions. You make sure that it is job related and consistent with business necessity. There is also, not anytime real soon, we're not there by a long shot, but a potential risk in not imposing a mandatory vaccination policy, depending on how your job environment criteria shake out when you run that analysis of whether it's a good idea to have one or not. So just in back of mind, it may be something you're thinking, oh, we'll avoid it altogether. We'll provide more information as more knowledge, more information is known on this, but it may not be something that some employers can simply opt out of and call that's in the safe zone. So we will keep you notified as we learn more. And that's it for me.
Great. Thanks, Sarah.
Mm-hmm.
Just to reiterate, because there's a lot of interest in the chat and the questions, and they are very good. We do review them. We kind of combine them into fewer questions, and that becomes the basis of our Q&A, along with questions that you all have sent in advance, and just things we know that are coming up and that people have questions about. So one thing, Sarah, that someone asked about, if you know offhand, otherwise this is detailed because I don't know how many people it applies to. It's around the applicability for the self-insured.
That's a great question, and I have not been able to uncover that yet. That may be something that we're waiting on. I think that's actually going to be determined in the next batch of guidance that hopefully comes out in the next week about how to deal with those reimbursable or self-insured employees versus, and I don't even know how they're handling the employees that are contributory employees, because ultimately they decided to just kind of forget 2020 ever happened for any amounts that were charged to individual accounts or organization accounts that were marked as COVID related. I don't know. My guess is that there would be a continuation, but that's not something that I can back up with anything I've found yet.
Okay. I'm going to comment quickly on this, on the 501c6 eligibility. I did not mean to make that sound more complicated than it is. It's just, there is 501c6s are eligible. However, only if they spend less than 15, I don't know if is it 15% or less than 15%. Anyway, we can figure that out, of their total expenditures on lobbying. But also, most C6s, chambers of commerce, trade associations, receive their revenue from dues from members. And as is required already by section 6033 of the Internal Revenue Code, you have to give your members a notice of what portion of their dues are tax deductible as eligible business expenses under section 162E, and lobbying or political expenses are not tax deductible. So every year there should be this, for those of you in the association world should be familiar with this, there's a portion of your dues from members that are attributed to lobbying, and the balance of your dues that are not used for lobbying. So if you, in fact, attribute less than 15% of your dues from lobbying, and your overall expenditures are only on lobbying are only no more than 15%, and your overall expenditures on lobbying do not exceed $1 million, which I don't think applies to most of you here, then you are eligible for a PPP loan. So enough said on that topic here, just because I think not applicable to many people. So I'm just looking at any other questions. Jeff, it looks like, are the requirements for the EIDL program the same as for the PPP program? And the answer briefly is no. And most importantly being that there isn't the requirement of using it on payroll in the same way. But Jeff, anything else you want to say on that quickly?
Well,
And
I guess I was inferring from that question that, are the types of eligible borrowers the same? And the restrictions that limit borrowers who are, kind of affiliated out of the country are the same.
got it. And 501c6s were already eligible for an EIDL, as were churches and 501c3s, so that doesn't change. Anyway, why don't we transition now to the people who joined late because of our large meeting upgrade snafu, which has now been fixed. And so those of you who want to stay on, ask a few more questions. As we said, the first part didn't miss a lot. Jeff was really reviewing kind of how we got to where we were at with having had the first round of the PPP last year and now with this PPP2. So Jeff, it was about 10 minutes into the substantive part that some people started to be able to join back in. So don't know if there's a few highlights you want to throw out. I just want to, as those of you start dropping off, thank the Madison Community Foundation again for supporting this. Really grateful for the service we can provide to the university. I'm sorry, to the community. And like I said, we will be sending out a follow-up email and posting materials. So, Jeff, anything else you want to point people to from the very beginning?
No, just kind of just general comments about I guess thematically at the beginning, I was just talking about how, because of all the bumps we had in the spring and how the rules kept changing and the forms kept changing, that it appears when we do have application forms, both loan application forms and forgiveness application forms, they are going to be first more borrower friendly, but they are also going to provide a type of flexibility that we haven't had before in terms of the types of costs that you can use loan proceeds for, the calculation of covered periods, etc. So, I'm anticipating that while there will likely be some bumps, the PPP2 is going to be more borrower friendly and more flexible than what we saw in the spring.
Great. And this is a good question. Can you apply again for a $10,000 EIDL that gets an automatic forgiveness in 2021? Or do you think that's a one-time?
That's a one-timer.
Yeah, that's what I assume. All right.
But again, if you kind of going back to, and we're going to have to see how it plays out, but I just saw in the chat, there were a number of questions about that alluded to the fact that lenders had not opened up the loan forgiveness portals yet, which means you haven't gotten your loan forgiven yet. If you haven't gotten your loan forgiven and you do have an EIDL, you should certainly revise your loan forgiveness application so that you don't have to pay that $10,000.
And we expect there to be a different loan forgiveness application in the near future.
Right.
And we don't know when that will come. But I mean, as we said a lot last time, and we'll say it again, is be in touch with your lender. Ultimately, they're the one that's going to, tell you what the process is and what forms you should be using and all that. If you don't have a lender, our experience is that for particularly the smaller nonprofits, that some of the credit unions and community banks in the community were the places to go. And someone else is asking if you can go for the PPP2 if you have 0 employees. No, it's the same issue as last time with needing, same issue as with PPP1 of needing employees or needing, in order to get it forgiven, you have to have spent 60% of your loan on payroll expenses.
Right. But even the calculation of the loan amount is based on payroll expenses. If you don't have payroll expenses, you can't even apply for a loan because there's no mechanism to do it.
Right. All right. We're continuing to see the fact that there are questions on how you calculate the 25% drop in revenue. We saw that. We're going to respond. We agree that whether the PPP1 forgiveness counts in your total revenue is a really important question. My gut is it does, but I have no real basis for saying that actually. So stay tuned. I know that's a really important threshold question, but it also makes me wonder if you couldn't just choose a different quarter. Right, so I don't know which quarter that your PPP loan gets added to. Is it the one where it's forgiven, where?
Well, it would be top line, it would be. Yeah, it would be cash in.
Right. So I would think if your cash came in May, then you compare to third quarter and you're going to have a drop in revenue then. And it's just showing one quarter in 2019 that was less than that same quarter in 2020. Right, Jeff?
Yep.
Yeah. Okay. All right. Thanks, everyone. Oh, cash or accrual. Yep. Yep. All right. We'll get some more details there. Thanks. Bye.